Welcome to TaxLawGH and welcome to our next video in the series on the taxation of gains and gifts. In the first video, we've looked at concepts covering the taxation of gifts broadly across all different streams of income. Then we started with the taxation of gains, and now we continue from here. So let's look at the concept of consideration received. What does the law deem to be consideration received? We're saying consideration received for an asset of a person at a particular time means an amount derived by that person for owning the asset, which includes an amount they derive from altering the value of that asset and in the nature of a covenant to repair that asset or otherwise, and also an amount derived by that person or an entitlement for that person to derive an amount in future with respect to realizing the assets. So we are saying that any amount you derive as a result of owning an asset will be deemed to be your consideration received. Obviously, this will arise on something called realization. But for now, just know that an amount you derive by reason of you owning the asset is deemed to be consideration received. This consideration received will also include an amount that you derive from altering or changing the value of the asset, and also any amount in the nature of a covenant to repair that asset or otherwise. Also, any amount derived or an entitlement to derive an amount in future with respect of realizing that asset upon realization finally will be deemed to be consideration. We are saying this does not include, so the following I'm going to mention does not include or doesn't cover what consideration received is within the meaning of the Income Tax Act. So an exempt amounts, remember, under income tax basic principles, we looked at the list under section 7 of the act, all the things that are exempt from income tax. We are saying any of those amounts will not be deemed as consideration received. Any final withholding payment will not be deemed as consideration received, and any amount that is directly included in calculating the income of that person under the concept of assessable income will also not be deemed to be consideration received. Remember this, we are saying the reference to a final withholding payment does not apply to trading stock, because trading stock has its own rules, as we'll discover shortly under the special rules in a few minutes time. So remember that consideration received does not include an exempt amount, a final withholding payment, and any amount that is included in calculating a person's assessable income for the year. Now that we know what cost is, we know what consideration received is, let's look at what the law deems to be realization, because it's realization that brings about a gain or loss that we need to consider how we are going to tax, as we have determined in part 1 of this video. What is realization? We're saying a person who owns an asset realizes the asset if that person parts with the ownership of that asset, including whether that asset is sold, exchanged, transferred, distributed, redeemed, destroyed, lost, expired, or surrendered. So remember, under the first part of this series, I was trying to use the word sold very loosely, because selling an asset is not the only way to realize it. You know, the ordinary or the layman will say, I sold an asset and made a gain. But in tax, when we say you've realized an asset, it's not about just selling. We are saying if you part with ownership of an asset, or if an asset is no longer yours, parting means it leaves your ownership, it's no longer under your ownership. And that parting with ownership occurs in a number of ways, then we say you have realized the asset. Take note, when you sell, that's what you already know, that's fine. But if you exchange an asset and you part ownership by way of an exchange, you've realized. Where you transfer the asset, you have realized the asset. Where you even distribute, you have realized. Where that asset is redeemed, even where the asset is destroyed, you have realized it. So if something happens, let's say there's a storm that occurs and your asset is destroyed as a result of the storm, the law deems that asset at that point to have been realized. You have sold it in the loose or everyday language. So remember, realization includes all of these, including where it's destroyed, even where it's lost. Where you lose an asset, it is deemed as realized. Where the asset is expired or surrendered to someone else, any of these will be deemed as you having realized an asset. And where there's a gain, you have to pay tax. In the case of an asset of a person who ceases to exist by reason of their death, then immediately before they died, we deem them to have realized the asset. So if a person owns an asset and they cease to exist or they die, then right before they die, at that moment we say they have realized the assets they own, for which tax will be due at that point. The rules we'll look at shortly, but we are looking at how realization is at this stage. Then we are saying that in the case of any other assets other than trading stock, what accountants will call inventory, or a depreciable asset which will be subject to capital allowance under the third schedule of Act 896, if the sum of the consideration received by that person exceeds the cost, then they have realized. So remember, we are saying that excluding trading stock, which has its own rules, and excluding depreciable assets, which has its own rules under the videos for capital allowances, if you've not watched that yet, we are saying any other asset, as long as the consideration you receive, which you've defined, exceeds the cost of the asset, which is also defined, then you are deemed to have realized, because you received more than you have it cost you to get, really, and you have made a realization at that particular point. We are saying in the case of an asset that is a debt claim owned by a person other than a financial institution, so they are exempt from this or they are outside the scope of this, if that person reasonably believes that a debt claim will not be satisfied, if that person has taken reasonable steps in pursuing the debt claim, and that person has written off the debt claim as a bad debt, then that debt claim is deemed to have been realized. So think about it. If you're an accountant or an accounting student, if you have a receivable balance or you have a debtor or account receivable in your books, and you are not a financial institution, you're not a bank, so this is for everyday businesses that are not financial institutions. If you believe that debt claim will not be satisfied, the person will not pay, or they've gone bankrupt, the person who owes you will not pay, you have taken all reasonable steps in pursuing the debt claim, and because it's not being paid, you have written the debt off as a bad debt, then you deem that debt claim, which is an asset in your books, as having been realized for tax purposes. Also, if that person uses trading stock, a depreciable asset, a capital asset of a business, or an investment asset in a way that changes the original characterization of that asset, this is deemed as realized. So if you use trading stock in a way such that it ceases to be trading stock, or it changes from trading stock to, let's say, depreciable asset, I don't know how that will work, whatever it is, then we deem that change of characterization, that change of nature, that change of use or function as realization. So if you use an asset in a way that it changes the original nature of that asset, then at that point of change, we deem that asset to have been realized. Then under the rules of section 62, where we talk about change in underlying ownership, and section 102 under change of residence, the rules there will also govern realization. We'll look at these under videos coming up that we'll call advanced income tax concepts. So just know that under those two sections, whatever happens there will also be deemed as realization. We are saying note that the above provisions on realization do not apply to the realization of an asset accruing to or derived by a company arising out of a merger, amalgamation, or reorganization of the company, where there is continuity of underlying ownership of the asset of at least 50%. So we're saying that despite all of this provision on realization, where there is a merger, there is an amalgamation, or there is a reorganization of a company, and there is continuity of underlying ownership of at least 50%, as in the ultimate ownership of the company doesn't change by 50% or more. So whoever was at the top of the group, when we check the ultimate ownership in sum or in aggregate, it didn't change by more than 50%. Then we are saying the underlying ownership has not changed, and as such, there is no realization within the concept that we are discussing today. Remember this. Let's try and apply this division to liabilities. You know, all we've done so far is to talk about assets, right? If you watch part 1, we spoke about gains or losses for liabilities. But let's try and apply everything we've done so far to liabilities. It's just the reverse of everything. What do we mean? The cost of and consideration received for a liability of a person are determined consistently with section 37, which covers consideration received, and 38, which covers realization, what we just looked at a few minutes ago, as if a reference to an asset is a reference to a liability. So it means wherever you see assets, just reverse the words and put liability there. We are saying the same principles will apply in summary. It includes the following: in terms of the cost, any expenditure you incur in realizing the liability, and in terms of consideration received, the amount you derived in incurring the liability. Also, a person who owes a liability, actually you owe someone, realizes that liability when that person ceases to owe the liability. And it includes where that liability is transferred, satisfied, cancelled, released, or expired. So if you owe someone, let's say you owe someone an amount of money, and you cease to owe the person, either by way of the liability being satisfied, being cancelled, the person says he has forgiven you the debt, being released of your duty to owe or your obligation to owe, or the liability expiring, then you are deemed to have realized the liability. Then upon realization, we ask ourselves, is there a gain? Is there a loss? And then we tax accordingly. Also, you realize the liability immediately before the person ceases to exist. That's where the person dies. Then we are saying immediately before that person died, similar to the asset. So where it's debt, if you owe someone and you die before you settle your debt, right before you died, we say you have realized your liability. Then also similar to the one for assets, in the case of change in ownership and change of residence, the rules there that also lead to realization for liabilities. I saying the provisions of what we'll look at next under special rules will apply with necessary modifications to a liability or an asset. So I'm going to show you shortly what the special rules for this division of the law are, and then we take it from there. So let's look at the special rules. What are the specific rules that you need to know? What are the interesting areas? This is where most of the meat of the material is. How do you tax transfers upon death when someone dies, or transfers to your former wife, your former husband? What does the law say? Before we even look at those, let's look at how the law defines cost of trading stock and other fungible assets. When it comes to trading stock, which you know to be inventory, which we have discussed at length when we looked at the business income series of videos, saying for the purpose of determining the cost of trading stock of a business of a person, an amount incurred in respect of the repair, improvement, or depreciation of a depreciable asset is not to be included. It only makes sense that trading stock is not a depreciable asset. So any amount you incur to repair, improve, or as part of depreciation of a depreciable asset, which you would have granted capital allowance to or for anyways, will not be included as part of the cost of trading stock. You don't double count. Also, a person making a determination of trading stock or the cost of trading stock will use something called absorption cost method for an amount that's eligible for inclusion in the cost of trading stock. So those who have done some management accounting before, some costing before, there's a special costing method called absorption cost method. Because my audience is varied, I have a lot of students watching. We're not going to go into the accounting of absorption costing. If you're interested, please just do a quick Google search of what absorption cost method is, and then you can understand it. Let's know what. Just know that takeaway point from here is that in determining the cost of trading stock, the law recommends that you use absorption costing. That's all, right? The owner of trading stock or any other type of assets that is deemed to be fungible and not readily determinable may use something called the first in, first out, or the average cost method. Once again, first in, first out, average cost are methods of costing for inventory, which are prescribed by the accounting standard IAS 2 on inventory. And as you know, under IFRS, the LIFO, as some people call it, or LIFO, last in, first out method is banned. You can't use LIFO or LIFO under IFRS. However, under US GAAP, LIFO or LIFO is permitted. But once again, because I'm saying this is not an accounting class, just know that takeaway point, under the Income Tax Act, you can use first in, first out and the average cost method, just as IFRS permits, right? So that's what you need to take away from here. Then we are saying the method opted for, what I just mentioned, may be changed by the owner with the written permission of the Commissioner General. So if you want to change the method used for costing your inventory, then you need to write to the Commissioner General. Now, before we begin to look at the special rules, let's look at some key definitions you must know. I'll mention this so many times, these two terms. So let's define them before we even get into them. We'll meet a term called net cost. We'll meet a term called market value. So let's define them and be free. What is net cost? Net cost for an asset or liability at a particular time is two things. In the case of a depreciable asset, which is an asset subject to capital allowance under the third schedule, it is the share of the written down value of the pool to which it belongs at that time, apportioned according to the market value of all the assets in the pool. So if you want to talk about net cost and that asset is a depreciable asset, then the share of the written down value of the pool. If you've watched capital allowance videos, you know what written down value of a pool is. So the share of the written down value of the pool to which the asset belongs, apportioned according to the market value of all assets in the pool. So it's about doing a prorating or pro rata basis for the share of that depreciable asset according to market value, based on the written down value of the pool to which it belongs. So if it's a computer, you use class 1, it's motor vehicle, use class 2, in that order. And in the case of any other asset or liability that is not a depreciable asset, the amount by which the cumulative cost for the asset or liability exceeds the cumulative consideration received for the asset or liability at that time. So when you sum up all the costs for that asset, take note, this is not for depreciable assets, this is for other assets that are not depreciable assets. If you sum all the costs, so to date accumulated for the asset or liability exceeding the cumulative consideration received at that particular time, then that is the net cost of that asset. How about market value? The law defines market value as a payment, asset, or liability determined in accordance with section 26, which is quantification according to market value. When you go to 26, what it tells you about there is that market value is essentially the value that you find as the market value for persons who deal independently. So if you are in an arm's length transaction, persons who are unrelated, how would they have dealt with each other? That will be the market value. So to find market value, it's not what you sell the item for to your grandma, to your mother, to your friend, but to someone you're not related, someone you don't know, someone you don't have an interest in or interest for, how much you sell to that person, an unrelated person, that is what we deem to be the market value of that particular item. Take note of this. So that's market value and net cost. Now that we know this, let's look at the rules, specific rules under realization and what the law says. Realization with retention of an asset. What does this mean? As in where a person realizes an asset in any of the manners below. For example, in the case of an asset that's a debt condition owed by that person, you remember I said if you're not a financial institution and you meet some conditions, you remember you have taken all steps to realize to recover the debt, you've written it off and all of that, those conditions, those three conditions. In the case of an asset that's a debt claim, that particular one, if the person uses trading stock in a way that it changes the original characterization, remember I also mentioned that, and in the circumstances for 62 and 102, those three conditions, if you realize an asset in any of these ways, we are saying that person is treated as having parted with ownership of the asset and has derived an amount equal to the market value of the asset at the time of realization. Then at the same time, that person is treated as reacquiring that same asset and in the reacquisition has incurred expenditure equal to market value. What does this mean? When you realize an asset in any of the above cases, debt claim subject to the three conditions, using an asset, trading stock, depreciable asset, capital asset, in a way that it changes the original characterization, and in the circumstances for change in ownership and change of residence, in any of these three scenarios, you are deemed to have parted with ownership of the asset and you would have derived consideration received technically that is equal to the market value. Then at the same time, you'll be treated as having reacquired, rebought the asset, and in the reacquisition, you have incurred market value. So if you have incurred market value to buy it back, and when you are selling, you got market value, it's market value minus market value, and there's no gain or loss in this case. That is the fundamental issue here. You are treated as having parted with ownership, and at the same time, you have reacquired it. So the consideration received will be market value and the cost will be market value. So here there is a neutral realization. How about where you transfer an asset to a spouse or a former spouse? So we are saying where on the death of a person, or as part of a divorce settlement, or as part of a bona fide separation agreement, an individual transfers an asset to a spouse or a former spouse. That individual who does the transfer is treated as having derived an amount in respect of the realization equal to the net cost, not market value. So remember that the law has done pick and choose. For some it's market value, some is net cost. You just need to learn the rules. What I just spoke about was realization with retention. I gave you 3 conditions. Those or that particular instance will pick what? Market value. However, transfer of asset to a spouse or former spouse picks what? Net cost. So just learn the rules as we go along. This is all you need to know when you're examined. So for transfer to a spouse or former spouse, you are treated as having derived an amount with respect to the realization equal to the net cost of the assets immediately before realization, and the spouse or former spouse will be deemed to have incurred expenditure equal to net cost. So where on your death or as part of a divorce settlement or separation agreement, you transfer an asset to a spouse or former spouse, then you will be deemed to have realized the assets, and how much you derive from the realization as consideration will be the net cost. Then the spouse or former spouse will be deemed to have incurred expenditure in acquiring the asset from you equal to net cost. So net cost on your side, net cost on their side as well. How about cases where you transfer an asset on death? This has nothing to do with spouse or former spouse. You can see here it's market value. So just learn the rules, just rules to memorize. So subject to the rules we just spoke about, section 43 on transfer of asset to a spouse or former spouse, where an individual realizes an asset on their death by way of transfer of ownership of the asset to another person, the individual who died and has transferred the asset is treated as deriving an amount, so here consideration received, in respect of the realization equal to the market value of the asset at the time of realization. And the person who acquires the assets, the person who inherited the assets upon the person's death, is deemed as having incurred an expenditure equal to market value. So take note so far, you've seen that some are market value, some are net cost. You just need to learn the rules as and when you go along. So on death, it's market value and not net cost. The next one is transfer of asset for no consideration. This is where you transfer an asset and there is no consideration. There's no agreed value as part of the consideration. What does the law deem to be the value in this case? We are saying that subject to the rules under transfer of asset to a spouse or a former spouse and the rules under transfer on death, where you realize an asset. And why is the law subjecting these rules to 43 and section 44? Because under those 2 cases, there will not be consideration in any case. When you are dying, or when you die and you transfer an asset to someone who inherited your asset, obviously they're not going to, or there won't be consideration as part of that agreement because they inherited your asset. Same way if you are transferring an asset to your wife as part of a divorce agreement, there will not be a legitimate or explicit consideration received. So the law is subjecting these rules to those particular sections. So it means those particular sections provision will override what we are going to talk about here if it has to do with transfer to a former spouse or spouse and transfer upon death. So those 2 stand alone. Let's look at the other conditions. We are saying where a person realizes an asset by way of transfer of ownership of that person to a person they are in a controlled relationship with, someone they are a related party with, someone they are in a form of relationship with, where the person transfer an asset to any other person, where they transfer an asset by way of a gift other than under a will, where they transfer an asset upon intestacy, which is where you die without a will, or where they transfer an asset to the spouse, child, or parent of that person, then that person would have been deemed to have derived an amount in respect of that realization equal to the greater of the market value of the asset or the net cost immediately before realization. So take note that transfer of assets for no realization, except for 43 and 44, which will be to former spouse or spouse and upon death, and under these conditions we've listed here at the top, would be not market value, not net cost, but the greater of the two. So another new rule to learn: transfer of assets for no consideration. The person will have been deemed to have realized at the higher of, the greater of what, market value or the net cost immediately before realization. What else must you know? This is what the person will incur. How about the person who acquires ownership? The person who acquires ownership of an asset in this form will be deemed to have incurred expenditure of the amount equal to the market value or the net cost immediately before acquisition. Why is the law using or and not the higher of? Because don't forget that it is matching concept. So whatever you pick is what the law will pick. So let's say in the realization part, the law says you pick the higher of market value or net cost. So if you pick market value, then here the person who acquires ownership will be deemed to have acquired expenditure or incurred expenditure equal to market value. If you pick net cost, they would have also picked net cost. That's why the law is saying market value or net cost. So it depends on what the realization value is. The higher will also apply here. So it's just going to match here. Where a person realizes by way of transfer of ownership to an associate of the person, someone they are in a relationship with, an asset which is a trading stock, inventory, a depreciable asset subject to capital allowance, or a capital asset of a business, and the four conditions I'm going to talk about on the next page are met, then that person, in respect of the realization, is treated as having derived an amount equal to net cost immediately before realization, and the associate would have been deemed to incur an amount equal to net cost. So another case where we call this a tax neutral transfer. There will not be any gain or loss on the disposal. What does this mean? Where you transfer ownership to someone who is your associate, so there must be an associate, there must be some form of relationship between the two of you, and that asset is trading stock or a depreciable asset or a capital asset, and you meet some four requirements or criteria that I'll talk about shortly, then in your case, realization will be as net cost. That's a consideration received, and the acquisition cost or the cost for the acquirer or the associate will be also net cost. So take note, this is for transfer of ownership of trading stock, depreciable assets, or capital assets to an associate. They use net cost. So please learn this rule as well. What are the four requirements I'm talking about? The first is that either the person or the associate should be an entity. Entity here means not an individual, so either company, trust, partnership, so that's an entity. That the asset is a trading stock, a depreciable asset, or capital asset of the business or of the associate immediately after the transfer by that person. So that asset that is the subject of the transfer should either be a trading stock, a depreciable asset, or a capital asset of a business of the associate immediately after the transfer. Also, at the time of the transfer, the person and the associate should be resident persons. So we don't want one resident associate and one non-resident. It won't work. Both of you should be resident. And the associate, or in the case of an associate partnership, none of the partners should be exempt from income tax. And the final condition is that there should be at least 50% continuity in the underlying ownership of the asset. So whoever owns the asset should at least retain 50% of ownership for this rule to be valid, or for you to get the special treatment as net cost consideration, net cost acquisition. Remember, so the requirements are four, just that the third point has two sub-points. So the first one is both of them, or either the associate and the person one of them should be an entity at least. Then the asset in question should either be a trading stock, depreciable asset, or capital asset. Then the third point is that at the time of transfer, the person and the associate are resident, and the associate, or in the case of a partnership, none of the partners is exempt. And finally, there is at least 50% continuity in underlying ownership of the asset. How about something we call realization of asset with replacement? What are the rules here? We are saying these rules will apply where a person realizes an asset in the manner such that the person parts with the ownership of the asset, including where the asset is sold, exchanged, transferred, distributed, redeemed, destroyed, lost, expired, surrendered, if you remember. And they acquire an asset of the same type to replace that asset to be realized, and the acquisition was done within 6 months before the date of the realization. Or they acquire an asset of the same type to replace the asset realized within 1 year after realization. What am I saying here? If you realize an asset in any of these forms or manners, such that you either sold it, you exchanged it, you transferred it, you distributed, you redeemed, you destroyed, it was lost, it expired, or you surrendered it, and then after realizing, you acquire another asset of the same type to replace the asset to be realized. So this is where you realize, or you foresee you realize, and you acquire another asset to replace the one to be realized. And you do this acquisition 6 months before realization. This is pre-realization. How about post-realization? Where after you have realized it, you acquire an asset of the same type to replace the asset within 1 year. Then these rules will apply. What does this mean? Under the B part here, this is where you foresee that you probably sell one of your assets. You know you will sell it. 6 months before selling it, you buy another asset to replace the one you are about to sell. That's what the law is saying here. Remember, the condition should be sold, exchanged, transferred, distributed, redeemed, destroyed, lost, expired, surrendered, right? Any of these forms. So let's say 6 months before you sold it, you could anticipate you sell, so you bought something else to replace it before you even sold it. Then we'll deem this condition to have been satisfied. It will be under realization with replacement asset. It will also apply where after selling and within 1 year after selling, you buy another asset to replace the same one you sold. So it must be a similar asset of the same type to replace the one you are selling. Then we are saying the person is treated in respect of the realization as having derived an amount equal to net cost of the asset immediately before the realization, and the amount, if any, by which the amount derived in respect of the realization exceeds the expenditure incurred in acquiring the cost, and the will be treated as what? Incurring expenditure in acquiring the realization asset or replacement asset, an amount equal to the net cost. So what are we saying here? Where you have realization with replacement, then you will be deemed to have realized at net cost. Remember, 6 months before for assets that you replace before realization, and then within 1 year for assets that are replaced or that you acquire replacement for after realization. So 6 months before, 1 year after. When you meet this criteria, you'll be deemed to have derived net cost, and as we see over here, the person will be treated as incurring expenditure and acquiring the replacement asset equal to net cost. So here is where you sell an asset and you buy one to replace it. That's 1 year, or even before you sold it, you got its replacement before the old one was sold. Then you have a period of 6 months where you meet this window, and it's under the criteria of sold, exchanged, destroyed, redeemed, all of those. You will be deemed to have done net cost realization, net cost reacquisition. How about realization by way of a merger, amalgamation, or reorganization? Favorite of examiners. We are saying the gains on realization of an asset that accrues to or that is derived by a company that arises out of a merger, an amalgamation, or reorganization of a company is exempt from tax, on condition that there is continuity of at least 50% of the underlying ownership in the asset. So any company that decides to merge, so let's say two companies come together, company A, company B, they merge to become one, like we have probably Airtel and Tigo came together to merge, whatever, or something called an amalgamation or a reorganization of a company. Any gain on realization of the assets as part of these three procedures is exempt from tax entirely. The gains will not be taxable on the condition that there's at least 50% of ownership still subsisting at the top, or the ultimate ownership in the group. Someone still maintains 50% of ownership. Then we are saying underlying ownership continues at 50% or more. So the gain will be exempt from tax. How about realization or transfer by way of a security, finance, lease, or installment sale? As in where a person grants a legal or equitable mortgage or a similar form of security over an asset to secure a debt owed by that person to another person, then the mortgagor shall not be treated as realizing the asset or any part of it, but rather as still owning the asset and as having incurred a liability, which is a secured debt, and the mortgagee, the counterparty, will not be treated as having acquired the asset or any part of it, but rather as owning the secured debt. So this is just a principle to learn. Mortgages, mortgagor, mortgagee. It's not too examinable, but just know it. Where an asset is leased under a finance lease, the lessor is treated as transferring ownership of the assets to the lessee. Subject to the rules we just looked at under transfer for no consideration, where a person transfers an asset under an installment sale or under a finance lease, then that person is treated as deriving an amount equal to the market value. So market value will be the transfer value for installment sales or finance leases. You'll be deemed as having derived consideration equal to market value. What will be the cost? Your guess is as good as mine. Will also be treated as incurring expenditure equal to market value. Where the lessee under a finance lease returns the assets to the lessor before ownership passes to them, other than under the rules for usual transfers from lessor to lessee, then the Commissioner General will treat the lessee as transferring ownership of the assets to the lessor. What is a finance lease? What is an installment sale? The definitions are in section 30 of the Income Tax Act. A very long list which we'll treat under the advanced income tax concept videos that are next in your playlist. So for now, just know that the rules for finance lease and installment sale transfers is market value and not net cost. So learn this as well. What must we know next? Realization by separation. Realization by separation. What does the law say is the rule here? I saying subject to the rules under finance lease or installment sale, which you just looked at being market value, where a right or an obligation with respect to an asset owned by a person is created in another person, including the lease of an asset or part of an asset. If the right obligation is permanent, then that person is treated as realizing part of that asset, but is not treated as acquiring a new asset or liability. If it is, however, temporary or contingent, then that person is not treated as realizing part of the asset, but rather as acquiring a new asset or incurring a new liability, as the case may be. What does this mean? If a person or where a right or obligation with respect to an asset is created in another person, including by way of a lease. So if for any reason your right to an asset or an obligation to a liability is transferred or created in another person, right, by way of lease itself, if the right created is permanent, then that person is deemed to have realized part of the asset, but it's not deemed as acquiring any new asset or liability. So if it's permanent, we say you have realized the asset or part of the asset, as the case may be, but you haven't acquired any new asset or liability. If it is temporary or contingent, then you are not treated as realizing the asset. So take note, permanent, you have realized, not acquired any new asset. Temporary or contingent, you have not realized part of the asset, but rather you have acquired a new asset or incurred a new liability. How does the law define permanent? A right or obligation is considered permanent where the right or obligation is to last for more than 50 years. So this has been a long session on the taxation of gains and gifts. Go through the rules carefully. Know which ones are net cost, know which ones are market value, and that is all you need to know really. We'll look at a number of exam questions where we put these rules into practice. At that stage, you should come prepared. You should know which ones are market value, which ones are net cost, which ones are the higher of market value or net cost, and look at the rules around taxation of gifts as well for a quick refresher. So until our computational aspect on taxation of gains and gifts, let's end here. And if you love this, don't forget to smash the like button and don't forget to share this video within your entire network. I'll catch you in the next video.